Welcome back to SR Money News. Today, we conduct a deep dive institutional analysis into HDFC Bank, India's largest private financial conglomerate. Following its momentous megamerger with parent entity HDFC Limited, the institution commands an unprecedented share of domestic credit and retail deposits. Its core moat rests upon an unmatched distribution footprint of over 8,000 branches, low-cost CASA deposit dominance, and conservative underwriting standards. However, this massive operational scale creates a unique structural challenge. When a financial entity becomes as large as a sovereign market proxy, maintaining historical compound growth rates while digesting a massive mortgage portfolio becomes mathematically complex. Retail investors often ask whether the stock's recent price stagnation signals structural decay or institutional consolidation. To understand this, think of the bank as a massive supertanker. While its engine is immensely powerful and stable, changing direction or accelerating takes far more fuel and distance than it would for a nimble speedboat. Analyzing recent financial statements reveals significant compression in net interest margin, or NIM, which contracted toward the 3.4% mark post-merger. To understand net interest margin, imagine a local grocery store owner. NIM represents the profit margin between what the owner pays for raw inventory from suppliers and the final selling price to customers. For HDFC Bank, the high-cost wholesale liabilities inherited from HDFC Limited acted like expensive inventory bought during peak inflation. While core interest income grew in absolute figures, the cost of funds rose faster, squeezing profit margins per dollar lent. Furthermore, return on assets experienced temporary dilution, moving away from historical peak levels above 2%. Total interest income remains robust due to sheer credit volume, but margin compression highlights the operational friction of replacing high-cost wholesale borrowings with retail deposits. This margin squeeze is the central mechanism driving institutional repricing across equity markets, forcing portfolio managers to reassess short-term profitability expectations. The primary operational bottleneck facing HDFC Bank lies within its loan-to-deposit ratio, or LDR, which spiked above 100% following the structural integration. Think of the loan-to-deposit ratio like a household water reserve tank. If your family consumes 110 liters of water for every 100 liters collected from rainfall, your backup storage rapidly depletes unless you slow down consumption or increase collection capacity. For a commercial bank, lending out more capital than it holds in core deposits creates funding strain and forces reliance on expensive short-term institutional borrowing. To restore systemic equilibrium, HDFC Bank must prioritize aggressive deposit mobilization over aggressive credit expansion. Achieving this balance requires offering higher interest rates on term deposits, which inherently keeps the cost of funds elevated. Until deposit growth systematically outpaces credit growth over consecutive quarters, balance sheet normalization remains constrained, keeping immediate return metrics under measurable institutional observation. In recent corporate guidance, HDFC Bank management outlined a deliberate capital allocation pivot aimed at long-term balance sheet insulation rather than short-term credit expansion. The executive leadership announced a targeted slowdown in corporate loan growth to systematically depress the loan-to-deposit ratio back toward historically sustainable thresholds. This process, known as capital rotation, involves reallocating balance sheet resources away from low-margin corporate loans toward high-yield retail assets like credit cards and personal loans. Think of capital rotation like a farmer redirecting irrigation water from low-value bulk crops to high-margin specialty, produced to maximize net income per acre without buying more land. Management guidance explicitly emphasizes branch expansion, adding hundreds of physical outlets annually to capture sticky, low-cost savings accounts. By choosing structural durability over temporary loan market share gains, executive leadership is signaling willingness to accept moderate near-term top-line growth in exchange for long-term margin recovery and asset quality protection. Evaluating HDFC Bank requires situating its balance sheet within broader macroeconomic dynamics and systemic liquidity constraints. The Reserve Bank of India has maintained tight monetary policies and heightened cash reserve requirements to curb inflation and stabilize systemic liquidity. Concurrently, competitive dynamics across the domestic banking sector have intensified. Peer institutions like ICICI Bank and Kotak Mahindra Bank are aggressively competing for retail deposits, creating an industry-wide deposit war. Think of this competitive landscape like a crowded room where every vendor is shouting to get customer attention. To attract depositors, banks must offer increasingly attractive interest rates, which raises funding costs across the entire sector. Furthermore, capital market returns have diverted retail savings away from traditional bank deposits into mutual funds and equities. This systemic shift in household financial savings limits the low-cost deposit pool, creating structural headwinds for major lending institutions striving to fund industrial credit growth. Turning to risk analysis, HDFC Bank faces clear vulnerabilities across cost inflation, regulatory pressure, and potential credit cycle turnarounds. A key risk is persistent deposit repricing pressure. If retail depositors demand elevated yield for longer, net interest margins will remain capped below historical norms. Additionally, regulatory oversight from central authorities regarding risk weights on unsecured retail lending presents regulatory headwinds. Higher risk-weighted assets mean the bank must hold extra capital buffers against retail loans. Imagine driving a cargo truck where regulators suddenly require you to carry twice as many spare tires in the trunk. The vehicle becomes heavier, carries less profitable freight, and consumes more fuel per trip. Furthermore, any systemic macroeconomic slowdown that impairs retail asset quality could elevate gross non-performing asset ratios, requiring increased provisioning coverage. These operational and regulatory friction points explain why institutional capital has temporarily adopted a cautious, observation-first stance toward valuation multiples. Looking forward, the multi-year thesis for HDFC Bank centers on structural valuation reassessment rather than existential threat. The stock's historical valuation premium, often trading above 4 times price-to-book value, has contracted significantly toward historical mean averages. This price correction reflects a transition from high-beta earnings expansion to steady, mature compounding. Consider valuation contraction like a high-performance sports car resetting its engine tune. While top speed drops temporarily during recalibration, the underlying mechanical foundation remains exceptionally resilient. As branch network expansion matures over the next 2 to 3 years, low-cost deposit accumulation will gradually lower the cost of funds, driving margin expansion back toward historical medians. For long-term institutional allocators, forward earnings visibility remains anchored by unmatched distribution power, dominant market positioning, and top-tier underwriting discipline, positioning the bank for multi-year capital compounding once systemic deposit equilibrium is fully restored. In summary, HDFC Bank is not facing an existential crisis, but rather navigating a structural integration and balance sheet recalibration phase following a historic corporate merger. While net interest margin compression and high loan-to-deposit ratios present temporary operational hurdles, the core franchise moat and capital adequacy remain bulletproof. Strategic patience and risk-managed balance sheet optimization will ultimately dictate the trajectory of its next multi-year earnings cycle. Thank you for tuning in to this institutional market breakdown on Our Money News. If you value rigorous, data-driven financial research without retail media hype, ensure you hit the subscribe button, activate notifications, and share your perspective in the comments below. How do you assess HDFC Bank's post-merger balance sheet transition in your equity allocation? Stay informed, analyze risk, and we will see you in the next episode of Our Money News.